Hello everybody and welcome to Green Star Trading with me, Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Now, I'm sorry if I sound a little hoarse, a little rough. I've had laryngitis the last few days and my voice went completely. I posted a video of me trying to speak on the Discord so that my members could have a laugh and appreciate the fact that I wasn't able to work. I sounded a bit weird. I'm definitely getting better. My voice still isn't 100%. It's a shame that I get back to YouTube finally and have the intention of creating multiple videos a week, and then all of a sudden fate turns around and trips me up. But that's such as life. We're back now and we're going to try and make up for it. So today we're going to be looking at crude oil. We're going to be using the CL2 futures. I do have a chart for the WTI, but I prefer to avoid it. The meltdown into COVID 2022 lows and going literally to zero does skew the chart quite horrendously. When we're moving between linear and log, we get a cleaner experience here in the CL2, but I do go back and check our lows and our highs between the two charts to make sure that they're valid on both. So let me just talk you through the basics of what I'm thinking here long term. We're just going to clear the chart. So we were in a long-term downward trend from the GFC 2008, and then we melted down effectively to zero. I know it doesn't say it here in the futures chart, but we did, into 2020 during COVID. We had a low, a lower high, lower low, lower high, lower low, downward trend, right? And we can see how the moves in this, the counter trend moves were a bunch of sideways chop or clearer free wave structures, right? Now, coming off of the COVID low, we can see that's not the case. We have a clear impulsive move of 5 waves into a high. Okay, with a prototypical extended fifth, which we often see in commodities markets. So if we were to measure that, we can see it goes beyond the level of 3. Strong wave 5. Strong wave 5 is typical in this market. So what does that mean coming off of zero? Well, it means exactly what I said it meant all the way back when we went to zero, that this is a once in a lifetime buying opportunity for oil, and obviously it was. You're never going to get a more obvious call than the market resetting itself. Time to be a buyer, right? So that was obvious and that was clear, but that doesn't mean it's the only one gone and never coming back. For a move off of the low that takes us above the prior high, and the prior high, 2 prior highs in the previous downward trend, is about as strong a trend reversal suggestion as we're going to get. So that means we've gone either A or 1, and this is either 2 or B, and then this will happen next, and this will be the next big bullish trading opportunity in oil. So don't feel bad if you weren't involved in the markets at the time, or you only got into trading after the 2020 lows. It probably was a once in a lifetime opportunity, but that doesn't mean there are no more, and there will always be more opportunities to come along. So on that note, we've gone up, we've come back, we've got a 1 or an A up here. Let's say 1, since resetting the market at 0 suggests that we now began a bullish trend. So we've got a wave 1. Are we done yet in a wave 2? Possibly. Let's have a look at some evidence with some classical analysis first, then we'll come over and have a look at the Elliott wave counts. So first things first, what have we done? Well, we've gone back to support. Okay, pretty strong support level. We can see that the prior lows here and the prior highs here, these highs have remained resistance, then they became support, and then they have stayed support. And we're above that major support level today at 65.83. We're above that major level. So we could have bottomed. In time frame, this is the length of 1. So this is our measure. And this is the cumulative addition of all the time afterwards. So this is 1 plus 6.618. This is 1 plus 1 again to give us 2. And this is 1 plus 1.618 to give us 2.618 in time frame. And we can see that the first low came in, and we haven't gone back below that low. And this was, when was this? This is a week chart, so that's the week of the 1st of May, where we came down into that low. We have not gone below that since, so that could have been the low at the 0.618. In terms of pullback, Fibonacci pullback, these are all linear measurements by the way, we've come between the 50 and the 61.8 and 65, the golden zone, the most likely place to bottom, to find the low, to find support. We're just below the visual point of control here, but if we just bring up our fixed point of control, right, we can see that's all the way back down here. This is based purely off of this move here, but we can see there's a lot of chop and volume in here. So we come back to major support. We've done enough in time. We've done enough in Fibonacci retracement. So we could have bombed. Right, we'll remember that when we come over to the counts in a moment. So that's the situation with the Fibonacci time, Fibonacci extension, retracement, and resistance and support. Weekly time frame, we're trading around the 250 exponential weekly average, having broken it to the downside. Back tested the 60 weekly moving average with a pretty bearish higher wick here. Not quite a shooting star, it's more of a doji because there's lower and higher wicks on it. And we're currently below the 60 exponential moving average. On the monthly time frame, we've come all the way back to the 250 monthly exponential moving average. Now, any return to the 250 exponential moving average on the larger time frame, we should be expecting significant support here, and we have it. We have that significant support at the moment, but it doesn't mean it's guaranteed to hold. Okay. Now, the day time frame, if the internet just wakes up, here we go. We've come back to test the 250-day exponential moving average, and then we have this strong bearish engulfing candle, gobbling of all of the prior day's bullishness. We've bottomed, and then we've come back up in a move into a high, and currently a higher low. So it may have been a move up, and this may have been a move back before we move higher, or that may have been a three-way move into a high, and now we come lower. These are all options. Right, so let's now have a look at our momentum indicators to see what we can see. So one of the things that stands out here on the daily time frame is this bullish divergence across the lows in the RSI, where we've gone oh sorry, that's the MACD, where we've gone low, high low, high low, high low, and meanwhile we've gone low, lower low, lower low, lower low in price. So we've got strong bullish divergence there. We've come back to overbought conditions here. On the weekly time frame, we can see that the recent low, although not the lowest low, right, has created an oversold condition on the weekly time frame, and the MACD has just crossed over average through the signal with a green bar on the histogram below the zero bound for the first time since crossing back below it in July. So this looks like it could be a bullish low in place, but it's not a lower low than this low here, and that means we have issues from a Elliott wave point of view. But either way, let's just get the OBV into play as well. We can see that we're ranging still in a very broad range on the OBV, neither breaking it to the upside or the downside on the weekly time frame. So still consolidating before we make anything really clear. Volume has ramped up on the weekly time frame a little bit lately, so maybe a sign that we're about to make a stronger move. But either way, it's not entirely clear, is it? We do have a little bit of hidden bullish divergence then, don't we? But we can't well, we don't, because we don't have a weekly close down here. I misspoke, sorry. If we had a weekly close here, we have lower lows in the RSI, higher lows in price. That's the opposite of the traditional bullish divergence, and would be a hidden divergence instead. Now, it's not the case because it's actually the opposite. We have lower lows in closing price. Right, so you can ignore that. There's nothing bullish about that at all. It's actually quite bearish to make lower lows and to make lower lows in the RSI. So it's a very tricky one. There's nothing screaming that's a low. Right? If this low, the most recent low, had come lower than our May 4th low, it would have been a lot better finish. It would have been a lot nicer look to it. A lot nicer look to it. And in the line chart, it will have a nice look to it, right? It's a lower low in the line chart. It's going to be a lower low no matter how you cut it. Well, it's not on the week chart, strangely, but it is on the day chart. A lower low. But we don't work with that. We're working with the candles here, and the intraday price took us down to that low. Either way, let's now consider the Elliott wave count. So we'll start with the bullish count first. We came up into a wave 1, WXY down into a wave 2. We now have another wave 1 and another wave 2. Very, very deep correction. But it does appear to be 5 waves up. Very deep correction. We're closer to the invalidation point than we are the prior highs. So if we were to break down below 63.90, this count is incorrect. Things I like about this count is we're close to the invalidation point, so we are closer to a managing risk from this position with our stop loss placement than we would be if we were trying to be bearish from here after such a strong sell-off back to support. We should probably be giving the bullish side the benefit of the doubt. Things I don't like about this count: we're a long way out of this wave 1-2 pitchfork. Even for a wave 3 extension to be forming, it would have to be absolutely enormous in order to get back into the fork in time. I do see that structure typically, but it would normally hold a better channel than the one we currently have. What do I mean by that? Well, if I bring up a simple base channel, taking the low that we made back here and the presumed wave 2 low and project from the one, we can see that we've fallen out of the base channel already. If this low over here of September 24th had been September this year, sorry, this is 5th or 6th of September, if that had been the low, we would have a much nicer look. Okay, so it does structurally feel like it wants to make a lower low. Right, structurally it feels like it wants to make a lower low, but we have come back to major support, and this is technically still the safest bet from a risk management point of view, to be bullish above the invalidation point. Break the invalidation point, all bullish bets are off in the short term. Bearish count. Okay, we are A down in 5, B back, and now leading diagonal into the low. Ending contracting diagonal into the low. The 1 has come down, the 2 has come back with inside the 1, the 3 has come down and is shorter than the 1, okay, which is nice to see, and the 4 has come back and is so far shorter than the 2. The 4 cannot come back beyond the 83.09, as the 4 cannot be greater in length than the 2. We would lose the contracting structure of the wedge. The 3 could have been longer given new rules, but it is nice to see it be shorter. The 5 must be shorter than the 3. So it must finish beyond where the 3 completed, but it must not be longer than the 3 in length. Okay, we don't know exactly where that's going to be because we're not convinced we've got the 4 in yet. It could be in, could come a little higher. We don't know. But either way, this would leave price a bit lower, maybe to the 61.8%, around $58, $59. But we can't go much lower than that because the diagonal structure won't allow it. Right? Like I said, that 5th can't be longer than the 3rd, right? So that limits our options. If we take it from where the 4 currently is today, that could bring us down to the 65% retracement. If the 4 comes up a little higher, right, it could bring us straight to the 61, where I'm roughly expecting it to be. And that's our bearish count. This would satisfy the idea of getting a better pitchfork placement for the broad wave 3 rally, which is going to occur afterwards. Pitchfork would be placed over here instead. Okay, and that would of course give us a better looking base channel as well. Base channel low would be placed there off of that high. So it would solve the structural issues we've got with the bullish count of being already finished down here on May 5th or whatever it was, 23. So that's the bearish idea. Then we've got a bit of a wild card idea, which is another bearish idea, which is we've been in a triangle the whole time. Right, we've had a 1 up, A down, and B has been a contracting triangle. This gives us the potential to come down a lot deeper. A lot deeper. Okay, maybe even make a double bottom with the COVID lows. We could stop at the 61.8 and still have a very short C. Doesn't appear to be enough room to do that, in my opinion. We could stop at the 78.6. There definitely appears to be enough room to do that, and we have a very strong ledge here, little volume node in the visual range volume profile. And then we've got the 89% Fibonacci level here, fib number of 89%. We could stop here. We cannot come back beyond the lows. We literally can't do that on the WTI chart anyway. We could do it here on the futures chart. But yeah, the possibility to come a lot lower. So if we melt down and we smash all that support, this is possible. But we should see volume increase very bearishly in this circumstance to support a total collapse in price. I feel, and it's only a feeling, this is why I haven't assigned primary or alternative, because we are just trundling sideways. It's very tricky. The bullish count is the most attractive from a risk management point of view, probably what I would back in the meantime purely for that reason. The bearish count is structurally the most sound, I feel, because it gets that one extra low and turns this into a free wave move, which is what it always feels like it should have been. Okay, so structurally it looks better, and it was set up for a better looking rally with a base channel off of that low. And then you've got the triangle, which I'd say is the least likely, as you know, we're talking about the deflationary collapse in the oil price. Suggests a major recession around the corner. It's not impossible though, right? And it would be a great opportunity to go long again. So there you go, guys. That's how I see oil at the moment. Relatively short and sweet today. I say that, but I always manage to ramble. And yeah, anyway, take care of yourselves, guys. I'll be back with you as soon as I can. If you're new to the channel and you've liked what you've seen today, please subscribe, smash the like, hit the little bell notification icon to remain informed of future video releases. And if you're interested in learning how to do Elliott Wave, and you're interested in weekly live streams and a whole bunch of educational videos and a great Discord community, feel free to sign up to the Patreon. Link in the description box below. And if you're not following me on Twitter, link in the description box below as well. Take care of yourselves, guys. I'll be back with you later in the week with an update on Bitcoin, most likely. All the best. Bye bye.